we get like
That's
a
good enough.
rolling wheel and it says that we're live. So welcome to the show, everyone. I am delighted to be chatting with you all again on this episode of CoinWatch. And this week we are discussing Synthetix and Augur, two incredibly interesting projects. As always, Paul Puey, absolutely delighted to have you on the show. He is, of course, the CEO of Edge Wallet. Welcome to the show.
Oh, great to be on for yet another episode. Let's cover these coins.
Let's cover these coins. All right. So which one do you want to start off with? We've got.
Should we go with the oldie but goodie, like one of the originals, Augur? Or should we go with the hot newness?
I mean, let's start with Augur. All right. So in essence, Augur is a decentralized betting market. It was like the original platform that made use of all the cool things that Ethereum has to offer. So you want to start us off, Paul, just give us an overview.
Yeah, so Augur's been on my radar from the very beginning, back when I was actually in San Francisco and went to a San Francisco Bitcoin developers meetup, and I saw Jack Peterson and Joey Krug present Augur for, I believe, the very first time. And for a lot of people that don't know, before the big boom of ICOs in 2017, Augur was actually the first ICO on Ethereum. And they actually tried to put this prediction market, that's what Augur is effectively a prediction market on Bitcoin. But obviously Bitcoin has severe limitations on its programmability. And with the advent of Ethereum, so wow, we can actually do this on Ethereum. It's one of the very, very, very first projects. I mean, truly bleeding edge with really poor tool sets available on Ethereum at that time. Them trying to build even on a language that's no longer even used. So Augur was actually built not on Solidity, but on a language called Serpent, which is more similar to Python. And they ran into a lot of different challenges.
Serpent, like when I remember going to this conference, I think it was like 2014, and Vitalik was giving a presentation on what Ethereum was going to be. And it was really interesting because he was explaining this new language, Serpent, and it was like something that he created. And so that was what Ethereum sort of started out with, people were building. It's very interesting.
Yeah, and Serpent I think, got its name from the fact that it was very similar to Python, which is yet another snake. And people realize that, for one, not as many people use Python now as they use JavaScript. And so the advent of Solidity now is a much more similar language to those that are very familiar with web development and JavaScript. And it just had more tooling and more hardening and more people using it and more bugs fixed. And so Augur had to go through the trouble of actually porting all of the code from Serpent to Solidity, I think right before they went into mainnet. So just in time after the security audits went through and realized, oh, there's a lot of security issues with Serpent, they went through all that trouble. So it's an oldie but goodie. It's one of the original ideas and one that excited the Ethereum community in its early phases, showing that, wow, there actually is a solid use case for all of this programmability. Going back to 2015, I think the ICO was 2016. The original founders, as I had mentioned, Joey Krug, Jack Peterson, and Jeremy Gardner at the time were really the people at the forefront, and they were the main faces of Augur. As I'd mentioned, they're the first ICO on Ethereum, and this was back in 2016 for the one thing I didn't quite get, it's been such a long time. All the tokens now, unlike many of the ICOs where people have tokens that are locked or getting distributed over time, it's been such a long time ago that pretty much all of the tokens are now liquid. And that was in 11 million total tokens of Augur that which are called REP. They're not called Augur tokens. Augur is the project. It's the decentralized prediction market. REP are the tokens, and it really stands for reputation. And ironically, we had just covered CoinWatch. I'm sorry, we had covered Chainlink, a few weeks back, and Augur was the first project to realize the need for a decentralized oracle. And the tokens of Augur actually are there to implement the decentralized oracle. That's one of the main reasons they have that. Obviously, all the other projects after have realized, yes, pretty much for the most part, it's really hard to have a decentralized financial product that doesn't use information from the outside world. And we're going to need that information. And hence everyone has to build their own oracle. And then hence why Chainlink came around and became a popular product, because they realized this is a common problem. But Augur was the first at trying to tackle this problem.
And it may be worthwhile us just explaining the need for an oracle, what it is. So like basically when you're dealing with the blockchain and let's say Augur, so it's a betting market, right? So let's say they're betting on, is Hillary going to win the election? And that's all well and good. You can have this smart contract that only is executed if Hillary wins or doesn't win. And how does it know whether or not Hillary wins, right? It has to get that information from the real world. Do you trust like a single person to get that information? Well, that's a single point of failure. That's easily corrupted. So how do you do this? And so Augur was like the first platform to really realize, okay, we need a decentralized oracle. We need a way to get information reliably from the real world and use it in these smart contracts. And they have an internal oracle, correct?
Correct. So the Oracle of Augur is what the rep tokens are primarily used for. So we'll talk a little bit about the rep tokens in Augur, because I'm sure a lot of people are like, well, should I get this coin? Should I not? What's the value proposition? And so that's kind of the first and main purpose of the coin, is for people to take rep tokens and effectively stake them to say, this is what I believe the answer is to a market. This is what the outcome is of a market. So for example, did Hillary win the election? Did Trump win the election? Well, I'm going to put some rep tokens at stake and say that Trump won. And if I'm wrong, or if a majority of the people vote against me, then I will lose those tokens, and therefore losing kind of reputation, right? And, or in a way you could kind of say rep stands for either reputation or reporting. So I'm reporting the result, and it also gives me a reputation. I'm staking my reputation and that money on being able to just simply say the truth. Now, the way Augur works now today, that's kind of how it was described early on. It's gone through a few iterations. One thing that Augur realized is Ethereum is expensive, and it's very expensive for a lot of people to actually put their input into a market, right? And say, okay, have 1,000 different people with a bunch of coins actually stake and say, hey, here's what I think the outcome is going to be. So instead, when you create a market, so Augur lets anybody create a market. That first and foremost, that's kind of a really cool thing about it. You can create a market on the outcome of a future event, no matter where you are, anywhere in the world. One of the things that excites me about that is that effectively allows you to create things like insurance from anywhere in the world. A farmer in the middle of Africa can put a market bet on what will the amount of rainfall be in their region after the end of the year. And in a way, bet against himself. That's all insurance is. People forget that. Insurance is just a bet. It's just a bet that in a way you want to lose, right? You want to lose that bet. Because if you lose that bet, that means the thing that you're insuring didn't need insurance. Right. So this allows people to create financial products in a way. That's all financial products are bets anywhere in the world, and gives that global accessibility that crypto is really built for. But the way the markets work today, I want to go back into that detail, is that instead of everybody betting or everybody reporting on the outcome, the person that creates the market specifies a single entity, a single address that's going to report on the outcome. So it does sound kind of centralized. Wait, you're only going to trust this one person? Well, yes and no. One address is going to report on the outcome. However, there's a window after they report where people could dispute that. And that's where everyone else's tokens can come in and say, oh, no, I dispute that. I'm going to put in an additional amount of money to say, no, I think the outcome is actually different. And that can go back and forth where people put more money and more money and more money into it until somebody wins. Someone just says, okay, we now have a critical threshold of money, and no one else is willing to bet the other way. And whichever side has the most amount of rep tokens staked is the side that effectively settles and wins.
So there's economic incentive to betting on the right thing. You know, if you're putting up money every time you dispute, there's a chance you could lose that money. So if enough people are going to go on the other side and say, no, this is incorrect, what you put isn't right, you know, there's a chance that you could lose that money. There's an interesting thing. Let's talk about what happens, because I think, how many rounds are there? There's like the iterations of dispute, because there's an interesting thing that happens when you get to the final round, because there is a cutoff. There's a cap on how many dispute rounds back and forth. There's an interesting thing that happens right at the end if no resolution has come into play, and there's a fork. So explain that process.
And this is the part that's unique about Augur compared to a lot of other smart contracts on Ethereum. Most other smart contracts, they just simply say, okay, well, whoever has the most, then whoever has the most votes wins. Whereas Augur, you might actually end up having a fork where there's two worlds that exist, one where one side won and another world where the other side won. And this is specific to Augur v2. So probably should rewind a little bit and let people know that Augur up until recently was in the V1 version of Augur, which used a V1 token, which has a very specific contract address. But now they've changed the contract of Augur, both the token and also the internal workings of the smart contract, and are launching that as now V2. And if you own a token, you should convert it over to V2. And people, there is this case that I'm referring to called a fork in this, and it's where one of the markets, market can cause a fork at one of the markets having a where
your sound is going in and out. I'm not quite what's happening. It sounds like a
sound kind of reliability issues.
Glitchy issue.
Oh no, technical issues are never our favorite. How are we sounding now?
You're sounding good. You're
sounding good now. Okay, all right. So hopefully we are able to hold the good sound. So the there's a chance in Augur where a market gets disputed and a lot of money gets put in on both sides. And the way the disputes work, you're right, there's rounds where someone says, I'm going to put in, you know, a rep token that disputes. And the other side says, someone else on the other side says, no, I'm going to put in 2 tokens. And I says, no, I'm going to put in 4 tokens. And I don't remember the exact amounts, but there's a limit to how much each side could redispute after after one side puts in a kind of a dispute amount. And it grows bigger and bigger each time, almost like doubling each time with the rounds. But as soon as, I believe it is 250,000 rep is put into the dispute back and forth, because you can see this has been going back and forth for quite some time. Then the system goes into a forking mode, where now all of the rep tokens now have to vote on which side is the truth. And in the meantime, while the tokens are in the process of voting, and you have basically, there's a 2-month period where the system is basically in a fork. During that time, if you do not vote with your tokens, you effectively lose them. And what's happening here is the system is forking, and the tokens are actually going to have 2 new contract addresses at the end of the fork. So if currently rep v2 tokens are at contract 0xAFB, 39, at the end of this forking period, they're going to be in one of 2 new contract addresses. And it's kind of a pain in the butt. Like, if you think about it, all of the exchanges and all of the wallets now have to update the contract address of rep at the end of this fork. But if you don't vote, then what happens is your coins get stuck on the old contract address, the one that will no longer be part of the future of Augur after the fork settles. So this is the use it or lose it that they're referring to in the blog post, and it keeps people not just simply holding their tokens, but also keeping track of what's happening in the system. Because if a fork does happen, you have to, number one, convert your V1 to V2 coins, and then actually vote using the Augur interface as to what you believe is the outcome. So it's a way of saying, hey, if there's a dispute, everybody comes in. We force everybody to come in to really, really figure out, well, what's the truth of this event.
Yeah, and it's interesting, like, I love the incentive model of having to choose which chain, right? Because if you think about how that plays out practically is, well, let's say that I'm trying to, corrupt it, and I put a lot of money in to put the wrong outcome in. Maybe I say, yes, Hillary did win the election, and I staked a lot of money, and then, or, you've got to realize that when this forking period comes, every single person in the network has to choose which side. Now, are they going to put all of their money into the chain that says that Hillary won the election? Because she clearly didn't, right? So people are going to, it's kind of wisdom of the crowds there. So people are most likely going to choose the one that actually had the correct outcome. So it's this very interesting scenario where, the incentives are not aligned for you to lie about this, because in the end, the most popular chain is going to be the one that actually represents reality. And it also is interesting to know that Augur has never, ever reached even close to this forking period. They've never had to resort to that. I think the most back and forth they've got is a few rounds. And it was interesting. I chatted to Joey about, what happened, what was the question was something about will the weather be good for this parade. And it was such vague parameters,
Exactly.
like how do you define like good, you know? And so, and there was another one that was about, will the Republicans hold the House or something? And the term of expiry on the contract wasn't actually the time when they actually took control. And so it's like, do we go by the letter of the law or the spirit of the law? Do we go by what was actually meant in the contract, by when the election's over, will they go? Or do we go by at the date of expiry of the contract, will they hold it? So there are some interesting things. It's a really fascinating system to kind of watch unfold.
It is, and I think the fact that it's, computers are very precise. There's no wishy-washy. There's not, oh, well, this is what I really meant. When you say something to a computer, it's going to execute exactly what you said. And when it comes to prediction markets, I think what we're seeing is that there's almost a marketplace or opportunity to find markets that are very, very well defined. And that's one of the challenges of a decentralized prediction market is people kind of say the way we normally say things, which is, humans are very vague. But if you don't say, will Hillary being president of, win the election, that even in a way can be somewhat vague. Like, does she achieve all of the popular vote, or does she achieve, the votes necessary to actually hold the seat in president? Unless you specify those things very precisely and you specify what year, what month, that the rainfall you're asking about is supposed to take place, then these marketplaces end up in this almost undefined state. And there is a case in Augur where basically money just simply gets returned because it's an undefined outcome. And reporters can report on that being, it's indeterminate. Ideally, those markets don't get a lot of money to begin with. If you're going to go into Augur and go, oh, I want to place a bet on something, there might be many different markets that are trying to bet on the same outcome. But the key thing that people are looking for is this thing well defined? Because I don't want to put my money in something where, even if I'm right, I might be wrong because of the ill-defined nature of how that market is described. And that's the piece that people do have to look for when participating in these markets, because there's no one to cry to if like, hey, but that's what I thought you meant. Well, make sure you read it. You almost want lawyers reading it, because lawyers have a similar mentality to coders and developers. They look, they want to see something that's a little bit more precise and less vague in kind of the letter of the law.
Yeah, one thing I will say is interesting, though, in the situation when they talk about will the Republicans take the House, they actually, the end outcome ended up being on the side of what was meant, the intent of it, rather than what was specifically there, which I found very interesting, because we're dealing with code that's very specific, and yet we're also dealing with humans and their interpretation of this and their interaction. So it's a kind of this very interesting interplay of like intent and all of that. And I want to just take a step back to kind of talk about why decentralized prediction markets are necessary, because the US government does not like prediction markets. It hates prediction markets. It's shut down betting on elections. As you'll notice if you go online, say like, well, I want to bet that Trump's going to lose, or I want to bet that Kanye is going to have a sweeping victory, like whatever. You can't do it in America, right? You can do it in a
lot of places.
Yeah, you can do it in Europe. There are certain jurisdictions where you can, and be mindful if you're using Augur of those jurisdictions and act accordingly to your choices. But the great thing about Augur is that it's sort of it's this permissionless decentralized system that is open to people to make their own choices on, and according to how they want to. Maybe if I'm in America, I might not want to use this, because if I visit somewhere else, I might say, okay, well, great, I can use this. But like it's such a necessary tool, because prediction markets are where the smart money is, right? You can vote on people. Like last election, everyone was voting, the polls, and they were saying like, who are you going to vote for? It's really interesting to see how different outcomes and predictions can be depending on whether people have money on it and whether people don't. Because if you put money on it, you probably believe it more firmly. You're willing to put your money where the mouth is.
Absolutely.
So it's like, I think Augur is like a necessary tool. Decentralized prediction markets are really interesting in my opinion.
And I think the thing that people forget about decentralized prediction or prediction markets in general, and betting in general, is that almost every financial service is some aspect of a bet.
Right.
And all of the financial infrastructure we've built are just simply bets. When you hedge, when you go from one asset to another, you're making a bet that that's going to do better. Whether that asset happens to be going from dollars to a hedge fund to a 401k, you're making a bet. When you buy insurance, you're making a bet. Notice one commonality between all of those financial services is any of those bets you make, the government wants to regulate, license, and make money on it.
Right.
So fundamentally, I think the main reason why you can't do these type of services is that the government hasn't created a way for them to really make good money on it. And they don't want access to everyone being able to take advantage of those services and keep it to the elite few. And there are those elite few that have access to a lot of betting, which stuff that's much more risky than what you might even go to when you go to Vegas. So betting is the foundation of a lot of financial instruments. By having a decentralized prediction market, you can create a lot of those financial instruments in such a way that they're accessible to everybody. And I've said this quite a few times, is that money is kind of the base layer of a financial service of an economy, but it's all the services on top of it that people also depend on. By having those services on top of it, we have a more complete way of exiting the current financial system, not just with the money. Because to me, if it's just the money, but then you just put those into custodial financial services, well, you kind of lose the point of the money, right? Like, you can, the self-sovereign, potentially private, you control it money, but then you now have to use it in a financial service where they hold it, they control it. Well, you only won half the battle. So this is a key piece to that. And I know that Augur's vision was that they build the protocol, maybe they build the first UI implementation, but other companies and other projects build UI on top of Augur that gives a different interface to provide more specific financial services that aren't just kind of global, like betting on all these different markets that you can see inside of their UI.
Yeah, for sure. No, it's really interesting. I'm just looking at some of the things right now. One thing that was interesting, like maybe we can talk about the tokenomics as well, but just like a more anecdotal thing, I asked Joey, what are some popular markets at the moment? Obviously, the presidential election is overtaking everything. People want to bet on this. And so that was very interesting. And apparently it's super tight. Like if you're talking about like bid-ask spread, there's like none right now. It's super, super compact. So it's very interesting to see that. And I think at the moment they have Trump at like 46% a couple of days ago, if that's helpful to anyone. So it's always interesting just watching these market results.
One of the things that was pitched by the team at Augur way back was that there's a prediction market which can help you build financial instruments and or just plain old-fashioned betting, the way people like to bet and potentially win and lose. But also it has the potential to be almost a search engine for the future. Right, to search for what you think will happen. You don't have to participate in betting and whatnot, but just simply look at what people are putting their money on. In the same sense that you can look at Google, what are people searching for on Google to help predict what's going on or what are going to be the new trends. You could look at a tool like Augur to say, what will the rainfall likely be? What will the weather be? Who will win the election? Who will win the World Series? When do you think we will open up and no longer have lockdown restrictions in California? All of those, in a way, can be something that you search for and in a way used to help manage a business that you're running, because business is all about helping predict what might impact your business. And so it's the search engine for future events. I think is a fascinating almost pitch for the need for a prediction market, decentralized or not. Although we just simply need it to be decentralized in order to be able to have it accessible and actually usable without government interfering.
Absolutely. And let's talk about the rep token itself, because you were mentioning like, well, there's an interesting platform, but is there an incentive for people to hold rep token? So what are your thoughts on that? Because it does seem that if you have rep token, it enables you to participate in this system and enables you to put down money and potentially make gains, especially if your opinion conflicts with someone. You can put your money where your mouth is. You actually earn money. You earn part of the pot if you end up being correct. So are there other incentives within rep?
There's three main incentives. So when you create a market, you have to put some rep down just to create a market in the first place. And the amount of rep you have to put in kind of depends on like the market cap of rep versus how much the kind of Augur network is being used. If the market cap is really, really, really high, like rep is worth a lot, but the Augur network is underutilized, like not many people are using it, then you don't have to put a whole lot, right? It's just they're trying to incentivize more usage of the market. So, but rep is generally used, yes, for that. You need to have some rep just to create and start a market. And then number two, for reporting, right? So if there is a dispute and you want to contribute your vote into the dispute, then you will need to stake some rep for the dispute. And by doing so, if you were to win the dispute, you get pretty much guaranteed 40% ROI on that. As long as you're on the winning side of that dispute, you got 40% ROI on that. And then the third is just simply good old fashioned stake your coins, and then you earn fees. And there's always a portion of fees from every market that go to the people that stake the rep. Part of the fees goes to the market maker, the guy, not the market maker in a trading sense, but the person that created the market in the first place. And they get to specify what their fees are, 5, 10, 15%, 1%. That's not in that, the network is in control of that. It's the person that makes the market that's in control of that. But the fees that go to, yeah, and they can specify what they want.
Yeah,
but
obviously they'll want to incentivize people to participate in their market. So there's sort of this competitive atmosphere where
exactly.
You don't want to put your fees too high, because if someone else created a very similar market and their fee's 5%, yours is 10, people are going to go to the 5% one. So it's very interesting.
Exactly. But the network does decide on the amount of fees that will go to the people staking. And like I had mentioned, as far as the utility of Augur, if there's underutilization of the network versus the market cap of Augur, then those fees are relatively low. If the market cap of Augur is low and the utilization is really high, then the fees go up, right? So that it incentivizes more people to stake. And by staking, it increases the value of Augur, takes coins off the liquidity pool, thereby increasing the price. So really it's using staking and the fees as a way of balancing out the market cap of Augur, which affects the security of the network. Just like the market cap of Bitcoin affects its security level, they're using staking as a way to increase the security if needed, if the total amount of money that's locked inside of the network from people putting bets in place starts to become fairly large. Like you don't want a lot of money being locked up in bets, but that's all being secured by Augur rep tokens that aren't worth much, right? In the same sense, if Augur rep tokens are worth a ton of money, they can secure a lot of volume, but the volume of money locked in these bets is really small. Well, then you almost want people using Augur more, therefore it reduces the fees paid out to the stakers. So it's a nice little self-balancing system. And it has, from what I gather, fairly solid tokenomics in the sense that, yes, you can earn real money by using the token if you're very active. And there's a reason to own it if you're going to use it. If you're not going to use it, then you're kind of banking on other people, staking it, other people actually wanting it to use in these markets. But it has a kind of this active and passive model for earning on the token.
Yeah, for sure. So do we want to move on now to Synthetix and talk about that? Are there
sure,
other things you wanted to cover on Augur before we move on?
I think otherwise it would be mostly diving into the gory details, and the numbers. And I think for the most part, most people are probably mostly interested in how does it all work? What are the base tokenomics? And I think we covered most of that.
Yeah.
Yeah, 11 million
tokens. Before we hop over there, I will just mention, so welcome. So Crypto Insights Journal just became a VIP member of NBTV. Thank you so much. That's obviously Jason Nelson's channel. If you guys aren't subscribed there, you absolutely should be. He does some awesome stuff. So Jason, thank you so much. And thank you to Crypto Insights Journal for your support of this channel. I really, really appreciate it.
Thanks, Jason.
Yeah. And also, if anyone wants to ask questions or anything, feel free to send a message to my CoinTree page. I'm checking that as well. So I'll answer those on the show if interested. All right, Paul, let's talk about Synthetix. This is an interesting project. It's sort of like, it's kind of like this universal ETF machine, or, I'm not quite sure how else to explain it there, but I guess if you wanted to start off just giving us an overview of this.
So there have been many attempts at synthetic assets prior to Synthetix. In a way, if people remember, gosh, I have the shirt. What was it called? One of the smart contract projects by Shapeshift that allowed people to bet on the price change on tokens without actually holding the tokens, where two parties basically stake Ether and one says, I think it's going to, price of Bitcoin will go up, or anything, the price of anything will go up. The other party says the price of that asset will go down. And the ether that's staked on both sides just simply uses a smart contract to say, who am I going to send the ether to at the end of this bet? It's a way of gaining price exposure without ever touching the actual asset. And sometimes you call that like a contract for difference. Right? You're making a contract where I am going to gain exposure to the difference in price from when I enter the contract to when I exit. That was one decentralized attempt at doing it. Gosh, what was it called? I still have the shirt too. Prism by Shapeshift. That's what it was called.
Like in the traditional financial world, they probably refer to that as like a bucket shop. It's usually used as like a pejorative when you are trading assets and not actually holding the underlying asset. But I think it's a really interesting system.
It's a valid use case. The most recent and probably biggest project or company to deal with synthetic assets, although unsuccessfully because it wasn't sufficiently decentralized, was Abra. So if for anyone that's used Abra, they let you, at least initially, hold Bitcoin. You actually had the private keys. You could hold Bitcoin inside of the app, but everything other than Bitcoin, maybe Litecoin and now ETH, but they claimed to allow you to buy, sell, and trade these like 30, 40 different assets, but they were all synthetic, meaning there was no actual asset being held by you. Instead, you're holding a contract with Abra where if the price went up, they owed you more Bitcoin. And if the price went down, you owed them Bitcoin. But because they were so locked on using the Bitcoin protocol, they weren't able to make it sufficiently decentralized. And actually, whether it be a month or a few months ago, they had to announce the unavailability of synthetic assets across many different countries, including the US. So therein lies the value of actually making this decentralized, which is what Synthetix has done. And so I've been excited about this project because I knew the value. People did want access to these other assets, especially US stocks. And I know that that's mentioned on Synthetix. They don't quite have it yet. I think their biggest challenge in offering that is they need to fully decentralize the protocol itself. Otherwise, Synthetix, the company, could be the target of SEC and other regulators saying, hey, you just added support for a US stock without any licenses.
And they're in the process of that decentralization. They're not quite there yet. They've done a lot of interesting stuff to make it, to get there. I think at the moment, like people don't realize, but they do have this super user system where they do have access to everything, but it's like a 4 of 7 multi-sig. And these people are distributed all over the world. But they are in the process of shifting that over so that it will be completely decentralized. It'll be in like a contract again, and people will be able to participate in that. And then another aspect of decentralization that I chatted to their team about it was, what was it? It'll come back to me. I'll mention it later when we're talking, but you want to continue?
Feed, maybe.
Yeah, exactly. So they were, they did have this internal oracle to get information about the prices, like, stock prices, whatever prices. And then I don't know whether it's happened already. A couple of days ago, they said that half of it was still internal and half of it they're using Chainlink actually. And then he actually said that this week they're transferring everything over. So all the contracts will now be using Chainlink. I don't know whether that's been executed as of today. As of 2 days ago, it wasn't done yet, but it was happening this week.
As of at least yesterday on their website, it appeared that all of the cryptocurrency synthetic assets were using their internal oracle, where they had full control, but all of the fiat and gold, basically non-cryptocurrency assets appeared to be from inspection using Chainlink. And so, if that's changed today or by tomorrow or Monday, then hats off to them to being able to at least decentralize the price feed.
Yeah, for sure.
So yeah, it's one step. And then there's the governance side, which I don't believe they've got that, that close in the roadmap to actually decentralize the governance of the project. Much like, we had talked about Compound releasing the Comp token, and that token being really, really focused around the governance. It almost had no tokenomics around anything other than you can vote for changes and new code getting into the protocol.
Yeah.
I didn't see much from Synthetix about the governance side and how they aim to decentralize that, but at least the price feed, they're on the right track there.
Yeah, it's interesting because talking about like what's the value of a synth token, because sort of like Compound when we discussed it, you have these two different types of tokens. You have the SNX token, which is the Synthetix token, but then you have like SBTC, whatever, you know, you have the synthetic version of all these assets. And so do you want to talk about SNX in particular and what some benefits there might be?
Got it. So the goal of Synthetix is to create these synthetic assets, right? That's the kind of end goal. Now, where does SNX come in here? The number one purpose of SNX is to be the collateral that generates these synthetic assets. So if you were to think about it from, I always like to ask these projects, let's start at day 0. Say there's nobody using your project. Give me an example of what token goes in, what token goes out. And so at day 0, someone could deposit a bunch of SNX, which SNX is a floating value token. It has an exchange rate relative to the dollar. It's volatile, it goes up and down. But say someone deposits $800 worth of SNX in the system as collateral. What they can do is they can mint another token. And the default token that you're going to mint is basically the SUSD, right? So everything is really kind of based on the SUSD token. So, and there's a very high collateral. From what I read, it was 750, 800%, which means you're putting in a lot more SNX in dollar-wise than you're getting out. So let's give the example. I put in $800 worth of SNX at the current exchange rate at that time, which is obviously is fed from these oracles. And then from there, it mints $100 of SUSD. And then I can take that SUSD and just trade it around. It's like a stable coin, right? And just go and bounce it around between people. Or I can take that SUSD and then mint another synthetic asset, such as SBTC or SXAG, which is silver, an ounce of silver, or SXAU, which is an ounce of gold. And all the contract is doing is it's saying, well, okay, what is the current price of gold in dollars? Well, that's how much you need to give me in SUSD to get 1 token of gold. Simple as that. And then now I have a token of gold that I can bounce around. And I can go in inverse. I can send back that token of gold, and at the then current price of gold, whatever that price is, it's going to give me that amount of SUSD. And so really, so long as the value of SNX and the value of gold the value of SNX stays high enough such that that collateralization ratio of like 1 to 8, that 800% is enough to back the value of gold, then the system is fine, right? But if you drop below that amount, then the system kind of gets into trouble, and it can no longer back the dollar equivalent value of gold with the dollar equivalent value of SNX. So SNX is key in the system. It needs to hold enough value and not be super volatile, since that is the collateral for the entire network.
Yeah,
but it's as simple as that, really. It's just a price feed. You're depositing SNX, it's the collateral, and it then becomes an exchange that is not an open market exchange. You can now use it, and it simply uses the price feed to say, this is the current price of gold to USD. Then you can turn gold into an SUSD. You can turn SUSD to SBTC just based on the current price from the external feeds.
Yeah, I think it's worthwhile just kind of reiterating and drilling down on that point that generally when you enter into a transaction or a bet or anything like this, you have a counterparty. So I make a bet or something and I'm like, well, I might trade Bitcoin for Ethereum or something. And so I say, Paul, give me some Ethereum, I'll give me some Ether, I'll give you some Bitcoin. In this situation, there's no counterparty. It's peer to contract, not peer to peer. So you're not actually exchanging assets with people like a decentralized exchange, even though it does sort of work somewhat like a decentralized exchange, the Synthetix platform, I mean. You're actually just minting this token, holding some other token as collateral for that, and you can switch anytime. If I get, like as Paul said, if I get synthetic gold and I want to switch it to Ether, okay, I just burn my synthetic gold and then I just get synthetic Ether. It's as easy as that. They're all interchangeable. I don't need to find someone to be the counterparty. Now, what I found was interesting there, because I was like, okay, so how does this work? Because you kind of have this debt pool. Everyone who's an SNX holder, all their resources are pooled together. And I was like, well, doesn't that present a problem? Like if the value and the collateral needed is dependent upon what kind of assets are in there and the volatility of those assets, synthetic assets, etc. Like, let's say that I decided to invest in synthetic tulips, and tulip bubble, like, you know, it goes right up, and suddenly these tulips, synthetic tulips, are worth a huge amount, and meanwhile SNX value goes right down, and I decide to cash out. Doesn't it make it difficult? Like, doesn't that present a risk to the system? Because if it's a volatile asset, I might be able to manipulate the asset. You know, I might be able to manipulate the market enough if it's a small enough asset that I've created. But the way they fix that is that there are only certain assets that are currently
right. Not every asset. So not every asset is supported. I presume that at some point, similar to Compound, there'll be a governance model that would allow people that hold maybe SNX tokens to decide what assets then get supported. And that you wouldn't be able to get an S tulip into the system, which is super volatile, or even any of the smaller coins. Something that has a reliable price feed and won't 100x, you know, overnight in value, thereby causing a problem for the collateral that's backing the tokens. So it's absolutely correct. The one thing about Synthetix is it has limits, right? Unlike actually holding the asset, it does have limits, and the collateral that's backing it has to be large enough to handle those limits. And the collateral has to be also not just large enough, but stable enough to handle the limits. So it's a good alternative if you can't hold the actual asset. So the biggest example, I think, which is worthwhile to me, it's almost pointless to have like SBTC, SETH, you know, especially SETH, because this is on the Ethereum network. So why hold SETH when you could just hold Ethereum? You know? If you're going to put these things into another smart contract that's on Ethereum, then okay, it makes sense to hold maybe SBTC as opposed to wrap BTC, right? Wrap BTC, it's fully custodial. Someone's holding your Bitcoin. You hope it doesn't get hacked. Whereas SBTC tracks the price, right? There's no counterparty like you had mentioned. Where I think it really adds value is in holding assets that aren't digital in the beginning. So gold, silver, and more importantly, stocks. This is where I think it's a big game changer. I know in talking to Bill Barhide from Abra, he had an immense amount of interest in the synthetic assets of US stock-based companies from countries that don't have access to it. Which makes sense. When you don't have access to it, you want it.
And maybe we should reiterate, like maybe we should explain that, because a lot of people don't realize that someone in Australia, for example, can't buy the S&P. You can't participate in index funds in America. People in China cannot buy assets that are American or Australian. You can buy them within your country. There are big walls that are put up to stop people moving capital between companies, and governments like it that way. So to have these synthetic assets where you can still benefit from the price movements of these things without holding the underlying asset, and it gives like access to this capital like never before. I think that's super exciting.
No, it's incredibly exciting. And that's why I think Synthetix has gotten a lot of notoriety and excitement around what they're building. It's another solid use case. And it is, once again, it's another bet, right? It's just another bet. It's another financial bet that while I can't hold the underlying asset, I want to bet that it'll still go up in value, but not so much that the whole system crumbles. And I'm also betting that Synth itself, right, the SNX token, is going to be strong enough and not downward vault enough to be able to hold the value increase of the underlying asset. So it's all of those bets in one when you hold one of these tokens. But for those that want to take the risk, it's better than saying, well, I'm not going to hold any Tesla stock at all because I have no access to it because my, you know, whatever trading account in China doesn't give me access to it. So it's
because I'm not an accredited investor.
I'm not an accredited investor.
Don't have $1 trillion, which is basically what you need to access these markets. Or you need to, you know, I mean, to use something like Interactive Brokers, you need to basically have a net worth of a huge amount in order for them to let you open an account. So it's inaccessible to most people. And that's devastating, right? You either have to, you're mandated to go through these brokers who charge incredible fees and, you know, aren't really necessarily providing that much value if you already know which stocks you want to go into. And so it kind of bypasses that. You get rid of the middleman and allows you to connect directly with these price movements.
Exactly. And so you had mentioned one thing a while back that I don't think we fully kind of went into, which is, you know, who are the ones that are taking this risk? Like if SNX goes down in value or Bitcoin or gold go way up in value, don't have enough collateral. It's the people that are staking and depositing SNX to mint new tokens, right? They're contributing to the debt pool, right? So they're owed an amount of SNX back. But if SNX drops in value, then well, obviously what they're owed back is going to become less than what they had originally deposited. And if the price of Bitcoin were to go up and all they had was SUSD, then obviously they're kind of in the negative. But the interesting thing is you're not making a single contract with a single other party. Instead of the amount you SNX that you deposit goes into a pool, and the people that are in a way short SNX by buying some other asset or holding a different asset, such as one of the synthetics of say Bitcoin, they have to gain if Bitcoin goes up in value, whereas the synthetics liquidity pool loses if that goes up in value, and vice versa. So it's a pooled risk across all of the holders in the system. And an interesting thing that Synthetix is doing, which is also fairly unique and excites me, is that it's offering an investment tool that's kind of hard to come by in the crypto world, which is inverse synths, which allows people to short tokens. So I'm not sure if you had covered this a whole lot in kind of your discussions with the team. And this has a bit of
I had to look that
challenge
up when I first did it, because I was like, okay, there's SBTC, there's SGLD, and then there was I, and I was like,
what's the I?
And yeah, so it's interesting. So if like you buy inverse BTC, if Bitcoin goes down in value, then you make money because you've bought, basically it's the equivalent of buying a short.
It's buying a short, it's exactly that. But it also has limits. So just like any kind of synthetic asset, this is a synthetic asset in the short of Bitcoin. It does have limits, and it also has a bit of a user experience challenge. It doesn't behave much like a normal token. So an SBTC, when you get an SBTC, it's kind of a simple unit of Bitcoin, right? I have one SBTC, and it, for the most part, tracks the price of Bitcoin so long as there's enough collateral behind the system. However, when you have an IBTC, how many units of IBTC do you get when you want to short Bitcoin, right? That's kind of a weird question. So if Bitcoin were $10,000 and I were to buy an IBTC, and at that moment in time it's worth $10,000, if Bitcoin were to go down in value, then the IBTC will go up in value. But then if someone else then were to buy an IBTC, well, what's it worth then? Right? Because Bitcoin is now lower in value, the IBTC suddenly, if it went down to $5,000, I don't buy an IBTC that's worth $5,000, it's now worth $15,000. So the problem with the IBTC from a user experience point of view is that it actually has a strike price, right? It has a strike price where it starts the contract, and let's just call it $10,000. That's the strike price. And as Bitcoin goes up, for every dollar it goes up, it goes down a dollar in IBTC value. Now, if it hits a certain threshold limit, I believe it's 50%. So if it was $10,000 at strike price, if Bitcoin were to hit $15,000, then the IBTC hits its lowest value possible, which would be 5,000. And then it gets capped and it actually gets liquidated at that point in time. You can't lose any more than that. In the same sense that if Bitcoin goes down in value and Bitcoin goes to as low as 5,000, the IBTC is now worth $15,000, but it can't go any higher than that. So it's capped to those ranges. And at the point when it hits that cap, the contract effectively closes, and that token is no longer experiences any price difference. So you can cash it out, you can turn it back into SUSD, and then a new contract would get created. And they just say, presumably a new contract would get created. So somebody in the system, I'm not sure how or why, would create a new contract at the new starting price of Bitcoin, which makes it a little bit difficult to hold these inverse tokens in your wallet. Because is this the IBTC from February, or is this the one from March at this strike price, or is this the IBTC from April at a different strike price? So you'll actually have many different IBTC contracts, all for different strike prices at different times, as opposed to just simply SBTC, which is simply at the price of Bitcoin. So a little bit of a user experience challenge, but if you can kind of get over that, it does enable you to do something very, very unique that many other products haven't given you an opportunity, which is shorting.
Yeah, exactly.
Asset.
Exactly. So what were some other things that were interesting about this? I'm just going through my questions here. like
probably the tokenomics of SNX.
Yeah.
There's a few things that people use SNX for.
Yeah, and they also changed the tokenomics. So they started out with a certain supply, and then they increased the supply, because they started out before the basically they were relying on certain things to pay people in the system, and then it wasn't enough. So then they decided to create this inflationary tool. So they actually increased the supply, and now it's at like a it's going to cap out at like a 2.5% increase every. Yeah. Do you want to?
So I think it was. We'll go down that. So they had, I believe, March 2018 was when they had first gone out and launched the token. 100 million tokens were kind of initially in existence, and that went to like investors, bounties, the partners, the foundation, the team, kind of usual, kind of like pre-mine of the tokens. And then after that, tokens then get minted, and it starts off at 75 million at the first year, and it gets cut in half, similar to Bitcoin, every 4 years, except this is every year they cut the issuance in half. So 75 million to 37.5 to 18.7 and so forth, until that basically went down to zero. That was the original proposal, and what I believe it's been passed is the new proposal, which would both smooth that out, so it's not so harsh like every year it just gets cut in half. Instead, it smooths out the curve, and instead of it going to zero, it goes to about 2.5% inflation in perpetuity, just forever. And I think that was I think the number I had calculated was about 200,000 tokens a week, I believe, and that would then go pretty much infinite inflation from there on out.
Yeah.
And the tokens effectively are given to people that stake the SNX in order to mint the synth tokens. So that's another benefit of staking your SNX, which obviously you're putting in a little risk, you're putting in a little bit of a bet to help contribute to the liquidity pool, into this debt pool, and in return you get some of these new SNX tokens that are minted.
Yeah. So it's I'm just looking through here the different ways that they kind of maintain the synth peg. And so we've got arbitrage. Obviously, they try to incentivize people. Like one of the other things I mentioned, like when I gave the tulip example, one of the ways that they kind of keep the system less volatile is by curtailing certain assets, and you can't just mint anything. But another thing that they do is by incentivizing, it's like I mean, I have to look into this a little more, but there are just different bets that you can take that also incentivizes people to go into other assets that are more secure. So to hold things like Ethereum, you earn different perks, and to hold things that are more stable, you earn different perks. And so that's how they try to keep the balance in more stable assets, so that the system doesn't go completely out of whack.
Well, the main thing is that they are adding, or I'm not sure if they have done it already, but they are looking at adding Ether as one of the assets that could collateralize synth tokens. However, doing that makes you not eligible for the kind of airdrop of minted SNX tokens.
Exactly.
As well, one of the other things that you do when you stake SNX to mint an S token is that you also get a percentage of the fees that are generated when people do exchange transactions on the decentralized exchange of Synthetix. All right, so the decentralized exchange of Synthetix, as we were mentioning before, allows you to take any of the S tokens and turn it into another S token. And it basically burns one and generates another. All right, so you send it tokens that it burns, and it gives you another token at the current exchange rate that it determines based on the oracle of price feeds, but you pay a little bit of a fee. And that fee ranges, between 0.1 to 1%. They say it's typically about 0.3%, and that goes pro rata to all of the people that stake based on how much SNX they've staked. Now, once again, to help give the system a bit more stability, they're looking at having Ether as one of the collaterals that you could stake, since Ether is a more stable asset and obviously bigger market cap than SNX, but you don't get some of those benefits. Right? You don't get the airdrop benefit and the fees benefit, but it helps at least still contribute to the liquidity of the system.
And it seems that people did really like this change in inflation schedule, that they did like this airdrop incentive, because Synthetix really kind of gained in popularity around the time that happened. People were interested in getting these airdrop tokens. So
and funny, they weren't really at the end of the issuance curve, right? Like it was still in the stair step stage of 75 million and 37.5 and 18.7. This is tokens per year that get minted. They weren't quite at the end yet, but I think they had realized if they did get to the end and it was coming within 3 years, that, or actually no, I think it was 4 years that they would get to the end, but they wouldn't have enough tokens to incentivize people to stake SNX, to give more liquidity to the debt pool.
Yeah.
And so hence the reason for the kind of, perpetuity, inflation in perpetuity, which is a hotly debated topic in other currencies, in Bitcoin. Like Bitcoin's, 21 million, that's like the gold standard. We cannot exceed 21 million. And a lot of people say, well, is that really the important thing? Or is the important thing that it's small and known? Like, what the inflation is going to be, and it's relatively small. And you can make a bet, or you can make a decision based on that known inflation. A lot of tokens are saying that, heck, we're making it known, making it small, and you can now make a decision based on that known inflation. And given that, not a terrible idea, right? If it helps secure the network, then so be it.
Yeah, I just got a super chat from Uvis, who says, dirty fiat for Naomi's hard work hardly seems fair. Dirty fiat.
If only super chat would let you actually send something other than dirty fiat.
Well, that's why we have CoinWatch, so people can send super chats in crypto, and I get to keep all of it. But I really appreciate your dirty fiat, Uvas. It may be dirty, and I may have to spit every time I say the word dirty fiat.
We can clean it into Bitcoin. We can
exactly. I'll change it into SUSD, and
it's a little cleaner.
Yeah, a little cleaner. But I really appreciate your support. Thank you so much. All right. So what's interesting about both of these projects is that, like, one of my questions was, have they received any regulatory attention? Because you're dealing with decentralized betting markets, which the United States does not like, and you're dealing with, essentially a universal ETF machine, which the United States doesn't like. And so that makes me kind of like both projects even more.
Exactly.
But I like that both of them.
When you stick the finger to the government, we like the projects even more.
Yeah, right.
I get it.
But I like that both of them are trying to go this decentralized route, because decentralization has this two-pronged benefit, right? On the one hand, you kind of give power back to the people, you decentralize it, you make it more secure, the more people who are involved, less points of failure. But the other side of things is that there's less focal point for governments to shut down. That's why Bitcoin is so successful. We had digital currencies before that were shut down by the government because they were decentralized entities. And with Bitcoin, it's completely decentralized, so there's nothing to shut down. So my hope is that we see this future of all these decentralized services where there are no more gatekeepers, where there are no more bottleneckers who are stopping people from accessing things directly and from instituting these unnecessary middlemen. So it's very interesting systems, both of them, and maybe we get straight to our verdicts. Paul, what are you looking at? I'm always going to go with you first, because you're the.
Okay, I'm going to remember this, because next week you're for sure going to go first. I'm going to go with Synthetix straight up. No more cheating this week.
No cheating?
And so no cheating this week. We cheated the first 2 weeks, but yeah, no, I think I want to put Synthetix on my portfolio. It's just simply a product that I think we need. I think the industry needs. It's key to just giving access to a lot of the world in financial instruments and stocks. I'm excited for when I see stocks on there. That I think then it's shooting through the roof, because that's huge. But they've got to decentralize it much further. But I think that they're potentially not too far away from that. So I'll put my money in SNX.
Yeah, their roadmap's definitely headed in that direction. They seem really keen that that's their focus. They want to go there. So that's exciting.
And this is no knock to Augur and Rep Token at all. Like, we almost covered two projects that if they were in different weeks, they'd be the choice.
Yeah,
for sure. So they're two great projects. Synthetix, I think, has a bit of an inch over. Just maybe it's just because of hot newness. Am I being swayed just by hot newness? I hate that. But yeah, it's not even that new. I know, the shiny new toy.
Yeah,
sure.
I'm going to choose the same, but only because I tend to not be an active participant in these things. I like to hold things and keep it and hope that it accrues in value and kind of forget about it. It seems that with rep tokens, I can maximize my gains by being really active. That I'm not going to be really active. I still love it. Like I can't stress this enough. I love the idea of a decentralized betting market. I think people should be interested in this and looking into this because it's cool. But I'm going to go with SNX as well, because I also love the idea of people having access to stocks that they wouldn't otherwise. You know, you need a middleman. People don't realize that you can't buy these things directly. You need a middleman. You need an app which, you know, serves as that middleman, or you need like a broker, or you need there's certain services you have to go through in order to get access. And I love the idea that I could have access to these price movements without that. So that's cool.
Exactly.
One thing I will mention about both of them, just a little caveat, is a lot of the projects we're covering, Paul, they're based on Ethereum, because this is a really cool DeFi world that we're living in. And Ethereum gas prices are through the roof. And it's going to take them a while to figure out, you know, Ethereum 2.0, and to, like, it's years away that they're going to be able to fix this scaling problem. And until they do, you know, I mean, it's a testament to how popular Ethereum is and how well it's working, that all these platforms are building on it. Everyone wants to be on Ethereum. There's so much potential there for doing these creating these cool financial tools or decentralized tools, but they haven't figured out scaling yet, and so it's real pricey. So keep that in mind. Hopefully we'll get there a few years out. I'm banking on it, and these projects are all banking on it too. But you can bet that if there are all of these interesting projects that are building on Ethereum, they're all incentivized towards the same goal as well. They got to figure out scaling. So there are a lot of smart minds that are kind of putting resources and mental power behind this. So I think it's definitely an interesting future.
Maybe we'll have to cover Ethereum again in the 2.0 era.
Yeah.
Figure out what's going on in that coin. But yeah, you're absolutely right in that sense. Luckily, a lot of smart minds, and there's a lot of money that's banking on Ethereum figuring out scaling. Too many projects. I mean, and interestingly enough, it's still being used even amidst the really, really high prices. But I think what's happening though is that it is now relegated to the people that can afford it. So it's not globally accessible to all the people that maybe want to be using it, but for, you know, the elite of us in developed countries that can spend $15 on a transaction fee. I actually, so I did get some SNX. It cost me $15 in a transaction fee to get it because it was a decentralized exchange. Painful. Yeah. Ouch. But I wanted to see the experience. I want to know what the cost is, see whether or not the transactions would go through just fine. But yeah, it's not something that I would do on a regular. Now I've just got to hold. I don't want to move the SNX.
Right.
It was only $100. Paid a 15% fee on it. So yeah, I hope we get to that. Sharding, scaling, ETH 2.0. I know that they've got the Ether team, the Ethereum team has one of the more true scaling solutions that I think actually is usable versus just simply making a block size bigger or just simply going to many layers on top. I think sharding is one of the future solutions.
I completely agree. I'm very excited to see what happens. Well, we have run out of time here. Everyone, thank you so much. Thank you to all the people who sent super chats. And let me just pull up that. Oh, just want to give my personal shout out. So to Jason, thank you so much for becoming an NBTV member. You are awesome. I really appreciate your support. Then Uvers, you're such a supporter of this channel. I really appreciate it. Thank you for your super chat. Thanks to everyone who's hanging out, chatting here. One quick mention, this weekend, if anyone is available on Saturday, every Saturday night, Decentralized Dance Party happens. It's like a DDP, Paul, you know about the DDP.
I've been to a DDP in Toronto, had a blast.
I know, they're the most fun. So the idea in a physical DDP is that everyone gets their own little boom box and you walk around the streets and you collect people as you go. And it's just like a dance party where you walk around. Yep. Now, obviously, there's less room for that at the moment. People can't travel as much right now. So they're doing these online ones. Every Saturday night, they hop on a Zoom thing. You just dance. They like announce things like grab a pot plant, and you grab a potted plant and you'll just like dance with it. They're like, get the biggest thing you could find. So you'll like get your
chair and your table.
Chair. You'll dance with it. It's really fun. Highly recommend it. And they're awesome people. So if you're looking for just a lift this Saturday, if you just want like good old fashioned fun, wear something crazy, put on a mask if you don't even want to be seen, turn off your camera if you don't want to be seen, but come join because it's super fun and it's all free. So I will post a link to everyone if you're interested in that. But Paul, as always, you're awesome. Thank you for sharing your expertise. If you guys are looking
Yours as well, thank you.
Yeah, if you guys are looking for a multi-coin wallet, make sure you're downloading Edge, because Paul is in charge of it and it's the greatest. And I believe that even before Paul and I became friends. So go and check that out.
So
actually, well, actually we became friends first because your work is something else before. But yeah. Even so, it's my go-to, and not just because I'm friends with him. Everyone, have a great day. I'll chat to you later. Goodbye.